co-head of iShares fixed income ETF, Steve Lapley, along with trader Keith Fitz-Gerald. Keith, am I right? I mean, considering the election is less than 2 weeks out, we've got a war raging in the Middle East. Where should investors train their focus if they're watching earnings?
Well, I think you want to be best companies only. Keep it on the fairway. This is not the time to be taking wild speculative bets. This is the time to be focused on the companies that are going to be there when you need them, Liz.
Okay, fine, because that's what we're seeing. We're seeing people jumping in and rewarding companies, right, Keith, that have done really well. For example, Tesla, which has been a big position of yours.
Yes, it has been. And you know, I'm very, very happy to see that. I wish, honestly, that Chairman Musk wasn't getting involved in politics as heavily as he is, because I think that's a distraction. But he's got a lot at stake, just like we all do. So I don't blame him one bit.
Okay, let's get to Steve here. Steve, I mean, you look at exactly what investors are doing, and it just feels like every time there's a sell-off, they're buying on the dips, and that they are interested in walking their cash off the sidelines, off fixed income and into equities. But you're a fixed income guy. Do you think investors have enough exposure to fixed income right now?
I don't. I think that, you know, for quite a long time, and if you go way back, you have to go back 20 years to get the yields that we're getting today. Yes, the cash rate is still high. The Fed has only cut once. There are more cuts in the pipeline, but it is time for investors to really think about that 40% of their portfolio and right size it. So we've been seeing a lot of flows, mainly into high quality. So call it intermediate duration, high quality core. You have the ag, you have BINC. BINC has been a popular fund, as you know, Liz. We've also seen interest in maintaining some of that floating rate exposure like our CLOA fund. But the point is that investors are finally moving, and we think they need to continue to migrate out of cash and into fixed income.
You know, when you talk about BINC, and that has attracted the most cash of any fixed income fund lately, it's done really, really well. Still, when you stretch it out to the day that it launched back in May of 2023, and you compare that to what the S&P 500 has done, there's kind of no comparison. I mean, look at this chart here. The yellow line is the S&P. S&P has been soaring about 38%. BlackRock Flexible Income ETF up 4.7%. Of course, that doesn't always take into account, you know, the distribution, et cetera. But what do you say about people say, wait, why am I putting it in that instead of equities?
Yeah, and I think that's an important point, but they each play a role, right? So BINC should not be returning, nor should the ag be returning what the S&P is. That would mean there's quite a lot of risk in it. Ideally, these things offset each other, and I think that's the point we're making is that, yeah, but you're going to give up the equity return, but you're going to get that diversification and balance that you need. And again, for the first time in a long time, you are getting income, and that's the key.
But Keith's an all equities guy very, very often if we talk to him. And Keith, you have really focused, as we said, on names like Tesla, on names like Palantir. But when you see investors diving into a Tesla like this, you say that it's really kind of an interesting move for investors to broaden their fixed gaze from Tesla to something like the Chinese version of Tesla, and that's BYD.
Absolutely, because, you know, Tesla, the thing about Tesla that people don't understand is that it's not just about the world we used to live in. It's the world we're going to live in. And when you look out at who does Musk fear, who does he think is the viable competitor? It's not Detroit. It's BYD out of China. And so I think that investors would be wise to think about what that company wants to achieve, particularly in light of the success that Tesla is achieving. BYD is a huge global player.
Tesla's about flat over 1 month. BYD, I thought I saw 17% to the upside here for 1 month. Pretty interesting, but that's just sort of just one kind of focus. But if we look at what Tesla has, and that is years of data, and Elon Musk on the call yesterday talked about his cybercab dreams, and he talked about, forget that for a minute because his stock has gone down since he announced the cybercab. But he said, forget that and look at the regular cars that he's making right now. Listen to how he put it.
There's no need to wait for robot taxi or cybercab to experience full autonomy. We expect to achieve that next year with our existing vehicle lineup.
Full self-driving autonomy. Do you believe that, Keith?
Oh, I think that the timing is not so much the issue. What is an issue for me is all of the other vehicle-related things that are going to surface in terms of data, AI, robotics. This is very much like 2014 when Apple suddenly said, we're going to do services. Today, that's a $100 billion opportunity every single year. I think Tesla is going to pivot and that vehicles are going to be a comparably small segment of its overall revenue a few years from now, which is why I'm so keen to hold on to this one.
Well, not everybody's so gutsy because it can be a wild ride. Steve, that's where you guys come in. And I feel like when people look at fixed income, they're just looking at treasuries. But where are the best opportunities outside of that in fixed income right now?
Yeah, I think we still believe there's value in high quality. So yet spreads are tight. They are certainly tight, but we think in the high quality
You're talking
corporate, high quality corporates, investment grade, we think there's still value there. If you're going into high yield, and by the way, it's interesting, high yield continues to return. So it's up 7% this year. It was up double digits last year. If you're going to do that, we would recommend being a little more defensive about it, either actively through something like BRHY or our defensive fund HYDB. That's a way to kind of play it a little bit more cautiously in high yield, but we think high quality is still a good place to be, intermediate part of the curve.
Okay, so that's a balanced portfolio, but not 60-40. Everybody says 60-40, 60% equities, 40% fixed is kind of yesteryear.
Everybody's different, right? So It just depends on your risk profile, but the more risk you take on the equity side, the more you should have offsetting on the fixed income side.
Makes sense. Steve, Keith, great to have you both.